Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Hey there. Welcome to our show, our podcast, our radio program. All kinds of things for all kinds of problems, all kinds of money. Well, okay, mainly dollars. I'm Don McDonald. Our phone number here is 855-935-TALK, 855-935-8255. And our goal is to, well, actually our overriding goal is to make you wealthier. We're just not going to do it the way a lot of people do it, which is by lying to you. They don't actually make you wealthier. They make you believe you can get wealthier by making them wealthier. And that's not what we're looking to do. You are invited anytime to stop by. 24 hours a day, 7 days a week, 855-935-8255. Now, I am getting ready to sell my Nissan Armada.
How come?
Okay. $120 a fill-up.
Is that what it runs?
That would be how come.
You're talking real money there. Yeah, okay.
It's a big tank, and it gets like 10 miles to the gallon.
You don't drive much, but still.
No, but plus I'm making money on it. That's one of the reasons why I'm selling it.
On the deal.
It's a leased car, but for some strange reason, because of the wacky economy in which we now live, the car, this never happens. The car is worth more than my lease payoff. Usually when you get to the end of a lease, it's like
they say, give us some money.
Yeah,
yep.
Yeah.
Mm-hmm. Yeah.
That's
true.
No, they're giving me another $9,000 over and above the residual value at the end of the lease. A little after I pay some other stuff, but anyway. So one of the reasons I'm getting rid of it is because gas is expensive. Life is expensive. Inflation. We have it again. I mean, it's annualizing out, what, at almost 8%?
Well, 7.9% February. Yeah,
and
that's a lot.
That has a lot of us a little concerned.
Well, it should. It should have you paying attention. Because here are the things I see around this when I talk to many of you. Number one, many of you don't know where your money is.
That's the truth.
They don't know how much in stocks, how much in bonds, how much in cash. Oh, I got that account. I got this account. How's it invested? You got to know. That's number one. Absolutely. Number two is if you are going to have an emergency fund or savings or something, this is a good time to be paying attention to the online savings accounts because rates, if you believe what's going to happen again this week with the Federal Reserve, things are going to go up. Rates have been inching up, not a lot, but you want to pay attention there because you can get something more competitive, and it's easy to do online to move that money right in there and make a little bit more. But here's another one, Don, and that we talked about last hour that people are struggling with, and that is you got to keep owning stocks.
Yeah, it's really
because
important. Stocks, we forget. Stocks aren't just an investment. Stocks are ownership in a business.
Yeah, and those businesses have a good track record of, guess what? Raising their prices, still being profitable during these. That's part of the inflation thing. But you own those, the price of those goes up. And so stocks have been a great way to offset inflation, no question.
And if you have a really well-diversified portfolio, and you're thinking, well, those darned oil companies, that price of that gasoline's I've heard this. I even heard it in an interview that I was part of. The oil companies are manipulating prices. They're raising prices so they can make more money. Well, then good. Own stocks and you'll own oil companies and you'll be profiting from the prices going up.
And here's the other one. Here's the other one you really should pay attention to. All of us should pay attention to. If you owe someone money, know how much you're paying because it still may make sense to refinance your mortgage. I mean, because there's still probably many people that are in the 4s and 5s and it might make sense to get down to the 3s. And if you have high expense credit card, personal loan debt, pay it off. Get rid of it. Clean it up. Make it a priority. And many people have not, because I still see people that have money invested but are still paying out 12% a year. I'm like, why are you doing that?
More than 12. There are some who are still paying 18, 19, 20 plus. And that allows people like these banks that are paying nothing to make a lot of money off of you. Hey, when was the last time you saw a savings account?
Yeah, how much?
Yielding 0.75%.
Been a while.
There's one now.
Who's doing this? Is it from Bankrate.com?
Yeah, Comenity. Comenity Bank is doing 0.75 on a daily liquidity account with zero minimum.
Just open an account, move some money in there. And because if you're going to have emergency, then the average savings account is still like 0.06 or something. The number is tiny. So if you go to Bank of America, no offense to Bank of America, you're going to make nothing. Use one of the online versions, and you're going to make at least something on that money. And, well, you're not going to keep up with inflation, but it's better than 0.06. I'll put it that way.
Yeah, yeah. And like on my checking account, I get 0.0000000.
A lot of zeros.
855-93. You know, it would make sense for me to move that. I mean, I'm looking at this bank called Axos. I've never heard of them. They're paying up to 1% on checking. There's a catch. I don't know what that is. We'll find out later.
Tom and Don are talking real money.
At some point, most investors need professional financial guidance. So get a little bit of free help or a lifetime of affordable 100% fiduciary guidance at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Doing a little Axos studying during the break, and you got to do a lot of stuff to get that 1%. You got to link accounts, you got to do debit cards,
you got direct deposit.
You got direct
Everybody
deposit.
Wants you to get your check going in there. Yep.
However, if you happen to be someone over 50 and you don't want to deal with all the headaches, or over 55, they do have
golden account.
They have the golden account.
Oh, come on!
Where you get free checks, you get reimbursement on ATMs, and you make 0.1% on checking, which is I'm getting nothing. So I don't know.
What's next? The blue hair special that you get 0.2 or something?
Blue plate. Blue plate. 855.
Not back to that again.
Back to the blue. 855-935-TALK is our phone number, and let's go to the phone lines where Pete has Pete. Yeah, Pete has been
paid. Todd. No, okay.
Pete, and then Todd.
Okay.
Well, I thought Pete was first. Pete's gone.
Nope.
Todd is there now.
Yep.
All right. I'm so confused.
Hey, guys.
Oh, Todd is first. You're right. She just okay.
Hi, Todd.
Hey, Todd.
Hey, guys. How are you?
Good. Thank you.
You hear me? Good. Hey, I'm just kind of curious. I listen to your show once in a while, and I enjoy it. You guys do a great job. I don't listen often, so maybe I'm out of touch as to what your advice is. But, with the specter of higher rates and easy money gone, and at least for now, and maybe for the foreseeable future, and fixed income, especially high-grade fixed income, not being the safe haven it used to be. What's your advice to most of your clients as it relates to a typical 60-40 portfolio or the use of fixed income? And I'm talking about high-grade fixed income, which obviously was down last year, down 3 and change this year. I run my own portfolio, multiple 7-figure portfolio, and have been in the business, actually investment business for a long time myself. So I use a lot of alternative investments that the average client can't necessarily get that have been great. Private REITs, private credit,
they can now with ETFs. They can get a lot of these things.
Well, yeah. Well, you can get them with ETFs. I don't think it's as good a way of doing it. But I guess my question is, how has your advice changed to the average investor out there as it relates to incorporating fixed income in your portfolio and / getting durable sources of income that, are protected against inflation, which, obviously a high-grade fixed income is suffering. So I'm just curious as to how.
Here's my question. Here's my question, Todd.
Yeah.
Yeah.
Sure.
My question to you is, what are you going to use as the alternative?
To bonds. I think that's what he's asking.
Right. Yeah.
Let me answer his question first, though. Todd, let me answer your question. Our advice has not changed. It has not changed.
Okay.
We are not market timers. We're not trying to stretch for yield. We're not trying, because every time, and Todd, I've been at this money stuff since 40 years now almost. And I got to tell you, every gimmick that's come along in the last 40 years has eventually failed. And I believe when you say that alternatives are a safe source of income, I think you're dead wrong. I think you're dead wrong, because most of the alternatives are private equity deals or private lending deals that carry risk that's unknowable. Now, they may say, well, you don't have any volatility only because they're illiquid. When you add liquidity in and you've got treasury bills fluctuating up and down, which are still by far the most solid source of safe bond investing.
Ben, we're going to give you just a minute here to give us one idea for the alternative, because I want to hear what it would be instead of U.S. government bonds predominantly.
Private real estate, Blackstone, private REITs.
Crazy
That is
dangerous.
no comparison.
Crazy
That's not comparison at all.
dangerous.
No, I mean, I would not compare any REIT to a government bond in any way, shape, or form. In addition, if you don't believe me, tonight when you get home, I'm sure you've seen this, watch Margin Call, and then you compare what happens in real estate, mortgages, etc., to what happens with U.S. government bonds. I would not put those anywhere near being the same asset class.
I'm not saying they're risk-free at all. I'm not saying
No,
that
but they're
at all. I'm
high
saying
risk.
In a world where people have. Well,
What did they do in 2008,
2009?
2009?
Yeah, no.
Listen,
But here's the thing.
Hard. There's no question about it.
Yeah.
When you own let me explain our portfolio philosophy, because here's where I think it gets confusing. People think we suggest bonds for income, and we don't. We don't. We suggest deriving income in retirement or whenever you need income from the entirety of the portfolio. We believe in taking risks that have shown over decades to have at least some consistency over decades. And real estate is in that category, but for only a small part. We believe in building a really, really, really well-diversified portfolio from which someone can expect to derive a reasonable income. And by a reasonable income, we're talking 4, 5, maybe if you stretch 6% per year from the entirety of the portfolio, with the bonds being there merely to suppress volatility.
Yeah, and I'm going to say thank you for your call. And this is an interesting topic of which we don't have time to spend that much diving into it. But I will also add this. While the 60-40 has not been great the last 6 to 9 months, if you go back 10 years, 20 years, 30 years, 40 years, 50 years, it's worked quite well. And you're going to say, but it's not going to work in the future. And I'm going to say nobody has any idea about that.
Yeah, nobody knows. Nobody knows a darn thing about the future. And I can tell you for a fact, Todd, this is just from my own experience in this industry, that every single year somebody is coming up with something new that is better than whatever it is that we've been using for decades. And they never, as a matter of fact, Eugene Fama, and if he is one of the most brilliant economists in the world, won a Nobel Prize. He has said over and over and over again that people keep showing him all of these better ways to make money. They show them to him nonstop. He says he probably sees one a week. And in his tenure, and he's in his 80s now?
He is. Mm-hmm.
In his tenure at the University of Chicago and elsewhere, he says he has seen maybe 5 ideas, 5 concepts that have shown some consistency of improving returns over time. And those can include things like small company stocks, value stocks,
volatility,
high income,
minimal,
high income, momentum has come in there. But alternatives have never, ever, 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 ever shown that they have staying power, in my opinion. People use them.
Well, I don't think my take would be you cannot compare them on a risk return scale to government bonds. And that's what my bond substitute. I don't think they're a bond substitute.
Well, and a lot of folks are looking at some of these private equity investments and saying, well, but they're not volatile. They don't go up and down. There's a reason for that. The securities within them do not trade. So you can't accurately value them minute to minute. That's kind of like your house. You sit there in your house, you go, well, my house is worth $1 million. Is it? My house is worth $500,000. Is it? You don't know what it's worth minute to minute. You do not, like we do with the stock market. You don't have that kind of liquidity. 855-935-TALK.
Tom are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
And it's not that we want to get into a big fight over any of this stuff. It's just that the evidence doesn't support many of the claims made. People are looking at things anecdotally, and we don't believe that anecdotes are a good substitute for evidence.
Especially lengthy evidence.
Yeah,
I'd say.
well, decades of it.
Right. Because this is what's happened the last few months. I got to make a change. That's another thing that really worries me. So
anyway, give us a call, 855-935-TALK, 855-935-8255. Oh, hey, wait, before I go, I just looked up the Blackstone Real Estate Investment or Income Trust. Yeah. This is here, and they're making the argument. I hate this argument. This is so spurious. It's tricky. And they even have to have an asterisk next to it. They're talking about their real estate investment trust that invests in non-traded REITs.
Yeah. Okay. That sounds safe. Sure.
So they say income driven, diversified, appreciation potential. Okay. Sure. Lower volatility.
No.
Asterisk. Well, this is a non-traded vehicle, which means the value of the shares is more closely tied to real estate fundamentals as opposed to. No, it doesn't. It means they don't reprice them as often. That is such a how often
can you get your money?
I don't know. All right. It says, but they have to in their little asterisk thing. They go, yeah, it's let me read it to you. I won't paraphrase. It's better if I read it. The share price is subject to less volatility compared to public equities because its per share NAV is based on the value of real estate assets it owns and is not subject to public market pricing forces as is the price of public equities. Although our share price is subject to less volatility compared to public equities, the value of the real estate may fluctuate and may be worth less than was initially paid for it. BREIT shares are significantly less liquid than public equities and are not immune to fluctuation.
You just basically don't know what the value of that is day to day any more than, as you just mentioned, the value of your home.
They basically just said, what we told you up there before, well, that's not really true. But
they just don't know.
855-935-TALK, give us a call. And Pete, you are now officially next. Welcome to Talking Real Money.
Thanks, fellas. I will give you my question and then a little bit of background. I've been comfortable with the accumulation stage of my financial life, but I'm wondering about when I will need to have a 100% fee-only fiduciary advisor. My wife and I are both 55. I'm employed. She is not. I have 3 defined benefit pension plans, 1 defined contribution plan. We have our IRAs, each of us. And, of course, the last layer of that is when to start drawing Social Security. So I'm wondering if I tend to retire at 62, which is going to be a little over 6 years from now, when I should seek an advisor to help me get ready when I need to draw down.
Get ready to get ready.
Yeah, I like that. Here's the thing. At 6 years, and believe it or not, you really are in the red zone. People think, that's a long time from. It's not a long time from now. You've got some complexity with the pensions, as you mentioned, the Social Security, and then making sure that the money that you've saved in those IRAs is proper when you consider all the moving parts. You may not need someone to manage your money today, but what you probably could use is someone that would even build a little plan for you to say, here's what makes sense in terms of when to take Social Security. Here's how the pensions fit in. Here's how your portfolio, you might consider having it put together based on having these other assets, if you will. So it all works together. I think 5 or 6 years before you retire, that is absolutely the time to get the plan. Whether or not you need to have somebody necessarily manage the money from that point forward, that is a different topic.
Okay. That makes a lot of sense. I
right.
appreciate that, and I will start. I know you got the form on your website for how to properly
at least meet with somebody.
Interview a fiduciary. So it
go
looks
check.
like a great tool.
Good luck.
All right. I'll go to work
Thanks
on
so
that.
much.
There's no rush now, so I can relax and do a proper
Exactly.
search.
That's another way to put it. Yeah, exactly.
Enjoy it. Take care. Thanks for calling. 855-935-TALK is our phone number. Oh, my gosh. I looked up the fees on this real estate thing. I got to save this for after the break. You will not believe the fees. You will not believe them.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Live in Seattle.
Reality radio for a really great future. We're talking real money.
All right. I'm going to let it go after this. But my gosh, I looked up this Blackstone Real Estate Income Trust, which buys non-publicly traded REITs. And I wanted to see what the expenses were, because this is
How much?
You gotta be a
the fees. Come
All
on.
right. The selling commission when you buy it through a broker is 3.5%. Not terrible.
God.
Wait,
you're
not
kidding, right?
terrible for a commission.
Okay, just to go on the record, we don't think you should pay a commission to anybody, but okay.
Well, but what's the management fee?
With that 3.5, I'll say 90 basis points.
Try 1.25.
Ugh,
Wait, there's more. There's an annual stockholder servicing fee of 85 basis points. Now we're at 2.05 annually. But wait, there's more. Not only do they get 2.05, but they also get 12.5% of the annual return.
It's like a hedge fund or something?
Yeah, kind of, sort of.
Weird.
Kind of, sort of. 855-935-TALK. Let's talk about your money, shall we? Dave, I think it's your turn to do just that. Hey,
Hi,
Dave.
guys. Thanks for it's great. Love it. Are you there?
Yeah, we're listening.
Yes.
Listening with rapt attention.
Yeah, I was saying I appreciate your show. It's great. At work, I signed up for a 401k, and they just by default, they put me into some funds. I wanted to run them by you and see what you thought about the distribution here.
Sure.
Go ahead.
I'm 50. I feel like I have kind of a comfortable with kind of a high risk thing. All my grandparents lived into their 90s, so I'm optimistic there. But anyway, they have 42% in U.S. stocks. That's VTSAX. 28% in international stocks, VTIAX. 8% in real estate, VGSLX. I'm assuming they like Vanguard here. 50% U.S. bonds, VBTLX, and 7% in international bonds, VABX. So it's 78%.
I think you're in a pretty good place, Dave.
Wow.
That's awesome.
Yeah, that sounds pretty good. I mean, the cost of the funds are low. You're well diversified. You got a little, not the real estate we were just talking about a minute ago.
You've got publicly traded real estate.
Publicly traded real estate at a very low cost. And you got some bonds in there. You got a little U.S. and international. I think that's pretty good.
I'm impressed with your employer.
Yeah,
This
me
was
too.
the default?
Yeah, I don't even think I told them my risk. I just told them my age, and they just threw these at me. On the other hand, I had a whole bunch of money in a checking account in Schwab, and 2 days ago, I was like, this is crazy. It's earning nothing. So I dumped a bunch of it, $3,500 into the VT, because you guys had recommended it. And then I'm like, well, that's the dumbest thing to do while Russia's rolling into Ukraine, possibly wanting to.
No. Okay. No.
Thank you for asking. Appreciate it. That's a good question.
You don't try to time the market based on world events. Earlier, in the first hour or yesterday's podcast, we talked about John Templeton, who in 1939, when Germany was invading Poland, he went out, he borrowed money, and he told his stockbroker to buy him 100 shares of every stock traded in the country, bankrupt or otherwise, that traded for less than $1 a share, because back then you had to buy round lots. You had to buy stocks in 100 shares. So he couldn't afford anything over $1 a share he wanted diversification. He bought every stock he could get for $1 a share in 1939 and then just kept buying throughout World War II. He made a fortune. And remember, World War II had just started.
And another thing around the buying stocks today, I always think buying things cheaper, like when they're on sale, is better than buying that they go up. So I'm kind of liking the idea of buying stocks now at a lower price.
Although I would make one little tweak to what you did because of what you have in your 401k, which is large cap centric.
That's
growth
true. Yeah.
centric.
Ooh, I've got an idea.
I knew Tom would have an idea now.
I would go with our old friend AVUV, the Avantis U.S. Small Cap Value Fund, ETF.
That you can get at Schwab.
AVUV. You could just move it right out of the VT into that. And by the way, the only reason I'm a little hesitant here with our advice to you, Dave, is when you say you had it in checking and then you move it all into stocks, kind of what's the long-term purpose of that money?
He's worried about the market, Tom.
Didn't like
right, Dave?
No, he went the other way. He went from cash to stocks.
But he was sitting in cash for a while, and he went, I got to do something, but he's worried about doing that. Right, Dave?
Well, yes. On this particular example, correct. Yeah. So,
all right. Get it in the market. We're running out of time. Thank you so much for calling and listening. And if you'd like, we've got a line open at 855-935-TALK just for you. Give us a call. I'm Don. That's Tom. We talk real money.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
The calls are rolling in to 855-935-TALK. But remember, you can call us 24 hours a day, 7 days a week, and get your questions answered on the podcast, too, if you can't make it on Saturdays. All right, Steve, it's your turn. You're up. Welcome to Talking Real Money.
Hey, Steve.
Oh, thanks, guys. Hey, how you guys doing today?
Oh,
hey,
I'm okay. Tom's a little testy.
Yeah, I got to take it down a notch here, so I'm okay. Thanks.
I was just out deck washing and doing that stuff and stepped inside. I'm going to call you guys. I'm a homeowner, and my wife and I own a second investment. It's a rental income condo in Issaquah, and we live in Puyallup. So I think you're probably familiar with those two markets.
Yes,
Tom,
I am
Tom
very
definitely
familiar.
is, yeah.
Mm-hmm. Yep.
Because Tom owns a home and a condo, too.
Don't get me going on that one. Yeah. Really got all the sore points going here. Go ahead, yeah.
So it's a rental income, and our renter has given us notice, and we did the walkthrough. We need to go through and probably do carpets and paint and get it back. But my question is, and we're kind of flipping coins, do we sell it? Is it a time to sell, or is it a time to just keep renting?
Sell it.
Mm-hmm.
Sell it.
Okay,
we're in total agreement.
Yeah, okay. Here's the thing about real estate right now. If I was a buyer or seller, I'd rather be a seller. But okay, but I guess the question is what would be your gain? What's your basis? How much would you be, having to pay tax on? Just out of curiosity.
Right. Well, let's keep it round numbers. We owe 50 value. If you look at Zillow and those, and two comps that just sold in the last 3 weeks that are the same units. 400 to 420. Rents are 22 to 23.
But what did you pay for it?
I think we paid 110.
Gee, good game.
That was back 15 years ago.
Yeah, and there's going to be some depreciation. So it's going to raise the base.
How old is the building?
96. 1996.
Yeah, here's the thing. Here's the way I look at all this. The real estate market right now is literally insane. You couldn't even make up what the deals or people are getting into. So, and I guess I would love to sell my condo right now. But anyway,
but that's another matter entirely.
That's another matter. I would be a seller. because it's just and condos can be harder to sell. There's all kinds of things that go along with that. So I would be a seller, get my money and invest it in some other manner.
And I got to tell you, Steve, my argument is more to the second point. I'm not going to market time, although I do believe this market is crazy. I don't believe that long-term condos make as nearly as good an investment. Condos have these hidden surprises, and that's why I asked about the age. Because there was a time, and the 90s were one of those times, when they were slapping condos up like they were going out of style. And so there could be all kinds of hidden assessments.
And they're harder to borrow money against oftentimes due to the restrictions. Again, if it was me, I'd sell it, get my money, pay my taxes, and move on with my life. That's just my take.
You've got unanimity from the Talking Real Money front. So go sell the darn place, pay the taxes, diversify your portfolio, own more things, less work, and I think someday you'll go, wow, that was really a good move. 855-935-TALK. Let's go to Mike now. Mike, welcome to Talking Real Money. Mike.
How are you today?
Good, sir.
Hello?
Thanks for calling. Yeah.
Okay, so I'll tell you right now, as far as finances go and stuff like that, I'm pretty simple. You know, you guys talk about all the Vanguard and this. Anyway, I'm looking at retiring in about 3 years here. I'm a firefighter for a living. And I'm looking at the annuities that the state offers in the law enforcement, the left system. And I know you folks don't seem to be real big into annuities, but I also have a 457 that has basically gone downhill a little bit here. But I'd be able to transfer, say, $500,000 out of that and increase my income $3,500 a month, knowing that it takes about 13 years to pay that back. You know, how do you all feel about the left version of those versus the private industry annuities?
The state of Washington actually has a very good annuity. It's called the TAP annuity. That I'm not.
Well, this is different. This is the left annuity.
But even there, it's a better product.
It's a better product than you're going to get from private. Yes.
Yeah, when you go out to buy it from an insurance company per se. So I'm not opposed to. I mean, again, but here's the thing, Mike. I don't know enough about your situation to tell you which is better. Because you need to really look at your retirement income, because when you talk about transferring money over and buying more income, I'd have to look at that whole situation, and you should too, with a planner first.
Let me try to make an example. You're saying how much money would you put into the left?
Well, if I took $500,000 out of my 457, that would buy me about $3,500 a month.
Joint or single payment. Life? Well, wait. Oh, it's a term.
That's single life. 13 years is what he's saying.
Is it it's a definite term then?
No,
your life or
it goes till I die.
But only your life, right?
And that's the thing I got to look at. If I put my fiance on it, that peels it back about $300 to $400 a month.
Right. So
here's
the deal. That is, I can tell you from all the research I've done into annuities over the past several months, that rate of return on a single premium annuity is really good. That is really darn good. That
40
is
$40,000 a year.
Yeah, that's the equivalent of a 12% payout rate or so, which is really extraordinary. Because remember, payout rates aren't based on income. You're getting some of your money back.
Of course.
So at that rate, you're doing quite well. It would, in other words, if you were paying yourself out from that, if you just said, I'm going to put this $500,000 in a mattress, and I'm going to pay myself out from that, that would last you no more than about 10 or 12 years. So this is a good deal for your life.
But again, you need a plan that looks at all of that first before, because this is decision way down the road after you've made the determination about the rest of your retirement income. That's what I would do first. Then you could plug this in to see what the better deal was for you and for your fiance.
But from a sheer simplicity, if she's going to be your wife, you're going to need to look at the joint life option for sure. Yeah. And again, that'll take it down to $3,000 or so a month.
But still, it's a good deal.
But still, that's a good deal. That's a very, very good deal. So this is one of the better deals, and it is only a better deal in large part because it's a state deal.
Yeah. Again, if you went to the private industry, you wouldn't get that same deal. Thanks for your call, and thanks for asking us about that. I wanted to remind people, by the way, all these questions get answered in one day on Saturday, May 14th in Bellevue at Retire Meet. Myself, Don, Paul Merriman, Herb Weisbaum, Rick Gregorick, Paul Lupescu from Dimensional. I mean, we've got some really great, all there. One day, get online, get
Plus
your tickets
all of our
now.
advisors.
Yeah, it'll be great. RetireMeet.com. RetireMeet.com. Get your tickets today.
Yeah, spelled MEAT.com. RetireMeet.com, because the sandwiches are great. 855-935-TALK.
Talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
And we, in addition to this show, want to help everybody with their money. And, this is for those of you who say, we tell you, you might want to have a plan. Well, you might want to get a little help starting that plan, even if it doesn't ever involve using our advisors. We still want to help people get the right start. So if you want to meet with one of our advisors, I can promise you you're going to get something out of it. I can promise you it'll be free. I can promise you there's no obligation. And I can absolutely promise you won't get a high-pressure sales pitch. So here's what you need to do. Go to Vestory.com and set up an appointment. That's Vestory.com or Vestory.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial product or securities. Instead, the program is provided as a public service by Appellate Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.